Hello and welcome to a special webinar from Fat Profits. My name is Roger Malik, the Head of Client Services in our Sydney office and your host for today's webinar. Our topic today is finding market bottom. That involves a lot of research and data points that we will discuss today. But before we get into the topics, I'd like to introduce our panel to you today who will assist me in this presentation. Firstly, our equity analyst, Gary Burton. Gary, welcome to this special webinar today. How are you?
Very good, thank you, Roger, and welcome everyone.
Excellent. And also joining us today is Colin Bransfield, our account manager, also in our Sydney office. Colin, welcome back. Hope you're well.
Thank you, Roger. Yeah, feeling fantastic. Friday, it's a great day. So welcome to all of our members. Look forward to a great webinar.
Excellent. All right. So this webinar is designed for non-members today. Basically, we want to give you a market update on where the markets are at. Obviously, we're in a bit of a downtrend at the moment. We want to expose some opportunities for you today as to how you can position your current portfolio and move this portfolio in the right way. So when we come out on the other side of this downtrend, you're well positioned to take advantage of these opportunities that are opening up left, right, and center. There are cracks opening up in the economy, in the global economy, and how, as an investor, you can take advantage of these cracks. Gary, any words from you as to what some of the key points we'll be discussing today and the opportunities that we can find?
Yeah, these what we're seeing in the markets at the moment, of course, is there's consistent selling on every second day, as everyone knows in the markets. But we view this as an opportunity. A long-term opportunity, not necessarily today, but a long-term opportunity to build portfolios. If you have an interest in building long-term portfolios and building long-term dividend incomes, then these current markets really do present a great opportunity.
Absolutely. So before we get into the webinar, just let me do a quick bit of housekeeping. First, all our presentations from Fat Profits are general in nature. We don't provide personal advice during this session. If you're looking for that, please see your financial planner or advisor. And also, past performance is no indicator of future performance. Now, we do have a Q&A session towards the end, so you can ask questions and we will answer them. If you've got questions on specific stocks that we are talking about today, please feel free, or the market in general. We are going to give you a lot of information that we've spent a fair bit of time in putting together for you today. So please feel free to write them down or take screenshots of some of the information that we put together for you today. So let's get started. First thing first, let's look at the macroeconomic picture that is currently taking place all around the world. And if we can sum that up in one word, it surely is inflation. That is rising around the world, or at least being very sticky now, and that's concerning all the central bankers and policymakers around the world. And everything is driven by this one word, inflation. Let's have a quick look at it. US, first thing first, you can see in the snapshot here, it's gone as high as 9% a few months ago. Now it's trading around above 8%. Look, the last 6 months or so, it's been between 8 and 9%. So pretty sticky. And it will take time and effort to bring that down. So that's a concern in the US. Let's move on to UK. That's even worse, 10% now and rising. So that's not a good sign. And the UK economy is certainly in trouble. And recently they've even lost their prime minister as well. So that's not looking very good for policy in the short term. If you go up to Euro zone, that's also a bleak looking picture. It's gone up from 7% a few months ago, now touching 10%. That trend is not looking very healthy and remains to be seen when they can bring that down. Australia, we are finally getting our monthly figures now instead of normally we used to get quarterly. We are now at 6.8% month on month, year on year. And the expectation is that by the end of this year, probably looking at 7.5% to 8%. That's also on the way up currently. Now, if you look at the other stats, what the governments are trying to do is try to bring the unemployment figures down, unemployment figures higher, which has actually gone to 40-year lows. So in Australia, with 3.5% unemployment, so a pretty strong labour market. You look at the US, very similar picture, 3.5% unemployment, very strong labour market. So if the labour market continues to be strong, that doesn't help the central banks. What they're trying to do is by raising rates, they're trying to make the labour market a bit weaker so that inflation can finally come lower. But it's not happening at this point in time. Let's have a quick look at market liquidity. Now you can clearly see here that the market liquidity has dropped. And what that simply means is the amount of money that is coming out of the market is pretty fast. You can look at October 2008 when we saw a big drop following the recession. And then you saw April 2020 was the last time we saw that. Look, we're not there yet. It's still on its way down, and we don't think we're close to calling a recession, especially in the US or other countries yet. So there's probably more to come here. But also looking at some other stats that we look at fat profits is how the fund managers are currently faring around the world. And if you look at this particular stat, this will also show you that the dark blue line, that's basically showing you the allocation to equities, and that's actually dropping as well. So the fund managers certainly being bearish, and the light blue line, that's the inflows to equities, and that's also slowing down. So that's not a great sign, and we can see that in the previous recession in 2008, that actually hit similar levels. So the current sentiment is certainly bearish. And finally, one more chart to show you that we also look at very closely at fat profits is the risk levels. Where are the risks getting spread across in different types of markets? So you're looking at emerging markets, credit risk and so on. And you can see a bit of a correlation. Again, history is a bit of a lesson for all of us. You look at 2007 to 2009 period, when the last time we saw all this sort of market downtrend, the risk levels really rose even higher than where they are today. But we're getting there now. And you can see, just only a year or two ago, they were at quite low levels. So these are all signs pointing towards a similar style of a market correction, market depression, whatever you want to call it. We are heading towards lower levels in the market. That doesn't mean it's all doom and gloom. There are opportunities. So Gary, let's have a quick chat with you first about corporate earnings. We've recently seen the earnings season in US, which is every quarter, kick in with some banks starting off with some positive numbers actually, and the banks have led the markets a little bit higher lately, and then followed by other companies like Netflix, which have had a pretty reasonable result, Tesla not so much, and the list goes on. But we've so far seen so far so good. How do you think the corporate earnings are reflecting the central bank's positions and rate hikes? Is it too early to see downgrades in the earnings yet, or is that a story more for next year?
Yeah, well, Roger, there are some earnings downgrades coming through at the moment. The expectation is around 7%. Bloomberg survey would suggest that. But what's more interesting about US, when I read the financial reports coming out of US companies, is that they're really on top of this. They're looking, they understand what's happening. There's no surprises in their thinking at boardroom level, and you can see that in their financial returns, that they're really paying down short-term debt. A lot of companies are paying down short-term immediate debt because of the rising interest rates at the moment. And we're seeing them essentially really tidy up their businesses. A lot of loss-making entities on the side are being shifted away, and they're really buckling up for this part of the cycle. So I don't think there's going to be too many surprises in this, and I'm rather encouraged that we see things like the airlines that are doing extremely well at the moment, in line with Qantas, which we may take a look at later. But that's the same on a global basis. Is the airlines, the travel's picking up. Airlines are doing well at the moment. We're seeing the oil companies really bringing in some solid cash flow, and so it's it's not we're certainly not looking at any black holes on a global equities basis at the moment.
Yeah, absolutely. Still quite early stage. So, in this chart here also gives you an indication of, the earnings expectations. This is for the US market and the momentum currently. So you can see the orange line is actually heading down. So the earnings indicator is on its way down. And previously we've seen that obviously capitulate in 2020. Of course, we know what happened there with COVID. But prior to that, a big downtrend happened again in 2008. So you're seeing some correlations to previous similar events. And look, here's a quote from Goldman Sachs on bounces. And they're saying, until the economy either enters a clear recession or shows sustained signs of progress on inflation, the pressure for tighter financial conditions is unlikely to abate, and periods of relief are unlikely to be sustained. So we agree with this statement, and at this point in time, we are in a bit of a holding pattern. Now, talking about corporate earnings, there is a canary in the coal mine, which was a bit of an early warning sign to the rest of the corporate market. And this was recently by FedEx, which we all know is the largest company in that space in the world. And not once has it happened in the last 40 years that their stock has fallen more than 20% in one day. And that happened recently because they raised an alarm bell saying there's a slowdown in demand and their earnings are going to be impacted over the coming 12 months. And that was not well received by the market. So that's also a bit of a sign of downgrades of other companies coming, as Gary also touched on earlier. Now, this one here is probably going to put that all into context. It might look like a bit of a messy chart, to apologize, but this is quite a powerful one because it shows you that the earnings versus rising rates or rising yields by the Treasury. So if you look at the couple of indicators that we've drawn here, so you look at 1985, the blue line represents the Treasury yield. So when the Treasury yield starts to go down, earnings go up and vice versa. So if you look at 2008, you will notice that earnings finally started to fall, and you see the black line here, finally started to fall when the yields started to go up. And that's what we're seeing now. The yields are again going up and the earnings are now starting to fall. And usually there is a lag in this. It doesn't happen immediately. It normally takes up to 17 months for this to really hit the bottom. So at this point in time, we still think we're at an early stage of downgrades in earnings. There's probably more to come early next year. And here's another interesting research stat for you. Now, there's a lot of talk in the media, and I'm sure you've heard this word a lot, is Fed pivot. And what the market is, at least a part of the market, is expecting is the Federal Reserve in the US to start going backwards and start cutting rates next year instead of raising rates, which they're doing now. And what the market is thinking is if the Fed pivots, then we are going to see a huge rally. Now, we're going to show you how this has played out in history in the past. If you look at this chart, you see the orange line. That's the Fed funds rate going up. So you can look back at in history and see back in 2004, 2005, they really started to raise rates. Now, as they continued to raise rates, the stock market actually continued to go higher. There were periods of consolidation, but the market continued to go higher. At that point, when they stopped raising rates anymore, consolidated the rates, the market continued to go higher. So yes, partly that's true, but when the economy really reached a place when we started to see recession bells, they started cutting rates, but that didn't help. The economy or the financial markets continued to fall, and we had the GFC as we know it. So that's not always following the pattern that if they cut rates, the markets will go up. It doesn't always happen. If you look at now and you look at the recent history, we're seeing a very steep rise in Fed funds rates, and they're going up, and they're probably going to go up for a little while longer before they start to hold. So in our Fat Profits view, we don't think the Federal Reserve will start pivoting anytime soon. At best, probably they'll hold rates for longer until they see the data to show that the economy is finally slowing down. At this point in time, there is no evidence that the economy is slowing down. So this stock market drop that we've seen so far is probably at the first stage. There will be some consolidation, there will be some bumps along the way. How far this is going to go down was anyone's guess at this point in time, but we don't think we have reached the bottom of the market. Now, Gary, this one here is actually quite an interesting stat, because this shows that the bear market usually go through in 3 stages. And in our view, we've seen probably the first stage, maybe we were partly into the second stage, but the third stage of a pullback is usually the biggest. And you can see that on the charts here. So that's usually the worst when people throw in the towel and they push the sell button. How do you see the current bear market in your opinion?
Yeah, so that's usually the capitulation stage, and that's the buying opportunity. That's when sentiment is at its worst. It's where the headlines are at their worst, and history tells us over 100 years that's essentially the buying opportunity as we see the market start to swing, which we obviously monitor every day. Market movements every day anyway, but there's a longer term picture as markets start to move up over days and weeks. It becomes a good point to actually start to add to your portfolio to build your position. And it's often companies, you'll often find actually share prices will recover very, very quickly, and so it's always good to be there when that occurs, rather than chase the market higher.
Absolutely, that's a good point, and that's the time that you need to be waiting for and be prepared for. This is one final indicator as well. This is the Buffett Indicator, obviously created by Mr. Warren Buffett, but this really shows, the trend line. The red line that you see is the historical trend line following the U.S. markets, and usually Mr. Buffett says that if the stock market has gone way above this trend, usually it'll pull back towards the center of this. And we've seen that in 2000, before the dot-com bubble. We saw that just before in 2008, when the market started to go up. And now we see the current market is absolutely at this highest level versus this normal average trend line. And we're still about a third higher than where we need to be. So it appears there is more downside to come before we get to that sort of neutral historical trend line. So these are things to keep in mind when we look at it. And here's one last indicator for you to keep an eye on today. And this is probably a precursor to recession. And what you're noticing here is these long gray lines. These are when recessions have happened. You can see 2000, you can see 2008. And just before the recessions have taken place, the US yield curve has actually fallen below the zero. It's actually gone into negative territory. You can see the worst crash of the 1970s. You can see that there, and then you look at 87, 2000 recession, and 2008. And yeah, we saw that happen just in 2020, and just before COVID happened, and we saw a quick recession with a recovery from that. But now we're seeing the Treasury yields again giving us a precursor of a recession. Pretty much the whole market is now agreeing The recession is inevitable in the US and other countries, and it's a story for next year. We're not there yet, but it is coming some point next year. The final thing here is the midterm elections. So currently, let's look at the short-term picture now. Short-term, there is a midterm election in the US in November, and these are historical numbers in midterm election years. The blue line that you see just there, that's your all midterm years. In October, typically the first part of October usually is a bit of a run, then there's a bit of pullback. But following that in November, December, usually there is a bit of a rally. Now, can we see that this year? Look, there is a chance. We're expecting a bit of a rebound in the markets in the short term, and we'll explain that to you in a moment. But Gary, I'm going to pass it on to you because you're the expert on charts. So can you run us through the next couple of charts, please? This is the S&P 500.
Sure. So the S&P 500 here, this is a weekly chart and shows the red line at the lower part of the chart is the 200-week moving average. And so 200-week moving average in the past, we can see around 2018-19 provided some reflection for a rise in prices at that point. We saw the COVID decline go through that average, and currently we're sitting back on that average. So an important inflection point for the market at the moment, and the ideal place to see a little bit of a rally inside this current downtrend.
Yep, absolutely. And can you show us in the S&P 500 current chart, how do you see that at the moment?
Yeah, this is a close-up look at the right-hand edge current market in the S&P 500. And what's got my interest about this is over the past 2 to 3 months, we have a divergent signal, relative strength divergent signal. Now, they don't come up very often, and they're highly reliable as a market reversal signal. And we're seeing that the market at the extreme right-hand edge there has made a new low, new closing price low down there, but the relative strength is starting to rise. So it's showing a change of momentum from the downside to the upside. And even though the market's lower, the calculations inside the market suggest that relative strength is increasing. So we take this as an early signal. It needs to be confirmed as yet, but we take this as an early signal. There's a turn coming.
So short term, look, we can expect probably a bit of a bounce, but long-term trend remains down. ASX 200, now this is probably more interesting for our viewers today, because they're obviously investing more in the Aussie market. How do you see the Australian market currently?
Yes, well, the Australian market has fared far better than a lot of the other global markets as far as index values go. And the big key points, there's 2 key points on here. One is 6,400, where we have a double low in the market. And again, you can see that the relative strength during October has put in a bit of a higher low just recently, 2 to 3 weeks ago. So it turned upwards again and set a higher low. So this 6,400 critical level on our market. Currently, the 6,620 level is an historic support level going back into 2021, 2020 and 2021. If you go over to the left there, you'll see there's a lot of consolidation around that area. And currently here we are on the right-hand side of the chart, and we're testing above that area. So the market looks very supported above this level. So in the short term, our view is that 6,620 is a key level to hold. And then if it has to be, then the market moves through there, then 6,400 is the next key level.
Thank you, Gary. Now, having learned all of that, now that's our macro view on the market. So hopefully you're enjoying the effort we put in to provide this information to you, and you're getting some picture on where the markets are at, both longer term and shorter term. But I guess the key message we want to present to you today is, what is the plan? How do you position your portfolio and make sure you're not losing too much capital? And when the opportunities present themselves over the coming months, and when we see that capitulation potentially happening, how are you going to position yourself to take advantage of that? So we certainly believe in planning for the future, And part of that, we're going to give you a 4-point plan today. And we're going to discuss these now with you in detail. So first thing first is stay defensive in the market. Preserve your capital. That's the first point. We're going to talk about that. Second is raise cash levels. Certainly need cash to buy some new opportunities when they become cheaper and available in a few months from now. We're expecting that. Third is avoid speculative stocks, which are certainly getting slammed in the market. And fourth and final is have lots of patience. And we can't stress that one enough. Patience is very, very important. So, Colin, over to you. Let's go through these points with our audience today. The first one is defensive stocks. So why defensive stocks? Here's a couple of names. What's important about them in this market?
Thank you, Roger. Look, defensive stocks are very important in this market. We're going through a period of volatility, and when markets are volatile, it's best to be defensive. And blue chip banks, other insurance companies, they are defensive stocks because they have a very good income return. So defensive stocks at this stage of the market are a very good play, Roger, and we're guiding our members to stay defensive.
Yep. We sure are. I mean, this is a bit of a snapshot from our daily emails that Angus, our CEO, sends to our members. And here's a quote we've highlighted in yellow for you. And he's saying, stay defensive. It is still too early to deploy cash with the SPX likely to remain under pressure and yet to form an important bottom. And he also adds on saying, we're also yet to see widespread capitulation. I expect to see the benchmark VIX push up between 45 and 50 before we can have the confidence that the lows are finally in. So these are part of daily communication channels that Angus, our CEO, and our research team provide to our paid members. And we are looking at the market very closely. So Gary, just have a quick look at volatility index VIX. This is a longer term chart of the volatility index showing us whenever we've had big market crashes in the past or market bottoms, this VIX has blown out well over 45. So can you tell us, run us through this, please?
Yeah, volatility index, essentially the way it's calculated is that they take a look at forward pricing on insurance options like put options and such against the current pricing. And the index measures the skew between the two, and we're not seeing that forward pricing really jump up just yet, but we're taking the view that it will come at the capitulation point, and that's, as we said earlier, that's often the opportunity to really set up some nice purchases inside a portfolio. So in Australia, we also have a volatility index called the XVI, and that's showing very similar pattern. It's not extremely high; it's up there a little bit, but not indicating any great move in the market just yet. But I point out that it is elevated. We do monitor it, and we'll be keeping an eye on it.
Yeah, absolutely. You can see there again in 2008, this really blew up to about 85, and the markets obviously reacted accordingly. Markets went down. So we're starting to see that, but it's still early days, so we'll keep an eye on that. Next up is financial. So, you know, Gary, financials are an important part of a portfolio in our view, especially the Aussie market. Can you run us through the financial index and what's it looking like at the moment?
Yeah, this is a weekly chart again. This financials index is a summary of the banks, other financial companies, insurance companies and such, just an index of their accumulated value. What this really highlights here is that just recently we've put in a higher low, just in October there, and we're starting to break away from that short downtrend line that's occurred from April-May period down to the current. We've kind of broken through there, which is really gets our attention in there. So a little bit of work yet to do. It needs to move over the 6,400 level on there, but this is early signs that the banks are in fairly good shape. We're seeing that dividends remain reasonably strong in the banks. They're the place to be in a rising inflation environment. where the reports that we've read through from the banks, they're not showing any customer stress just yet. And funny enough, to most people's surprise, is that deposit savings are actually increasing, not only here in Australia, but in the US as well. So there doesn't seem to be a lot of stress in the bank. So this chart of Westpac here also shows the same type of pattern, where we have the higher low currently at the right-hand side, and it's really currently testing that downtrend line. A breakthrough there would be quite significant. Now, again, at the bottom of the chart, we have the relative strength. Relative strength moving over the 50 level is currently reading 59, but relative strength moving over that middle line is a very positive view of current momentum. It shows that price momentum is positive at this point in time in the chart.
Excellent, good summary there. And I like your charts, Gary. They're very clear and easy to understand. The trends are very important. Trend is your friend. But the key message, I think, what we're trying to let you know is financials is one sector which is defensive. It is on its way up. The dividends are very strong, and we're confident that this will remain resilient even in this downtrend that we're seeing in the market. So that's one to look at. But Colin, over to you, because we also publish an income report every quarter, and that includes an income portfolio that you can run us through, because that has a lot of defensive stocks.
Yes, it does, Roger, and thank you for that point. Really, most of our members look at this report on a regular basis, particularly during times of market volatility, bear markets, etc. They really do rely on this income report, Roger, to get a consistent income flow, over 5 to 6% and sometimes higher with some of those blue chip miners and the blue chip banks. Some of those dividend yields are around the 10% mark. So as an investor, as a member, if you're continuing to record income of around 10% on your portfolio stocks, then you'll do quite well, even though capital values are falling back as the market's weakening. You've still got a consistent flow of income coming through in your portfolio. So this Fat Profits Income Portfolio Report is a very, very good report in volatile times, Roger.
Yeah, very good point there, Colin. So just to fill you in, this has 22 stocks in the portfolio. They're all within the top 200 and the ASX. And we've chosen these 22 stocks as a model portfolio for our members, so you can look at it. You can choose the ones that you like the most, or you can just copy that portfolio. And our results, we're very proud of that. You can see the results right at the bottom. And apologies, we can't show all the names, of course, on the left, because you're not a member yet. But that's just to protect information for our paid members. But the results of this portfolio, we're proud to share with you. It's performing at the bottom right. You can see 17.1% annualized returns for the last 10 years, and that's from 22 stocks in the top 200. Now that 17.1% is a combination of dividends and growth. So generally speaking, you're looking at about 5 to 6% dividends a year and another 10-11% in growth. That's the current annual rate that it's running at. Now, you compare that to your own, and I'm sure you'll do the maths, and this is probably the single biggest reason why we have 25,000 members. This here, Colin, it shows a forecast dividend yield over the next 12 months, yeah?
It does, Roger, and thank you for that point. As I mentioned a moment ago, some of the stocks in this report have dividend yields over 8% for full year 23. That's a gross yield, and that's fully franked. So what we see with our income report is a very good benefit of franking credits. Once you factor in franking credits, there are some very good returns over 10%. So this is valuable information for all investors to get a good, strong, consistent return on income, even through these volatile periods where you may see a reduction in capital value, but you've still got a good, consistent income stream.
Absolutely, that's very good. And the portfolio average is forecasted 6.6% dividends over the next 12 months. That's across board, but certainly some are higher than the others, so you can cherry pick. So this is one reason you should consider joining our service. But look, coming back to the plan, so the second point of the plan, apart from staying defensive, is raising cash levels. And we can't stress that enough. But Colin, we have raised plenty of cash in our managed funds at Fat Profits. Can you run us through that, please?
Yeah, so raising cash is a fabulous thing to do during volatile periods. And typically, Roger, what we're advising our members and investors to do, wherever possible, take profits off the table. And in the last several months, we've had a number of sell half recommendations on a number of our stocks. I might just mention a couple of them, Whitehaven Coal and Hub24, for example. Our members have taken significant profits off the table. By doing so, they've accumulated a cash position of anywhere between 25%, and some are actually 50% in cash, Roger. So if you're in 50% cash at the moment, you're in a good position to buy undervalued stocks on the dip as the market bottoms out sometime over the next 3 to 6 months. We don't know exactly when it will bottom out, but based on our understanding of the market, it probably is nearing the bottom somewhere in the next 3 to 6 months. That would be the time to dive in, jump in with your cash position and buy some fantastic undervalued stocks.
Yep, that's the plan. So Angus currently, this is a picture of our CEO, Angus Geddes, in an interview with Ausbiz. So he's sitting on about 30% cash in his Australian portfolio, and he's also let the market know he's sitting on about 60% cash in the global portfolio. That's a large amount of cash for a fund manager. But he's been mentioning that to our members for several months now, and a lot of our members have followed the advice and they are sitting on cash. So the question you need to ask yourself today is, are you sitting on cash? If yes, is it 5, 10, 20, 30%? What is it? Could you do something to improve those levels? Well, if you could, that would be our general advice to you. And these are some snapshots of daily emails that Angus writes to our members to communicate. Now, Colin, Fat Profits has been around a long time. Maybe some of the audience might not be too familiar. Could you run us through who we are, what we do?
Yeah, so we're a share market research house and a wealth management company. So the benefits of being both a research house and a wealth management company means that we've got tremendous information, knowledge, expertise, and experience in investing directly into the market. So Fat Profits has within its wealth management division about $250 million Australian dollars invested directly into the market via our listed investment companies and what's known as our self-managed accounts. In addition to that, we've got a fantastic, a very high quality share market research division, which specializes in providing guidance and recommendations to our members. And so the combination of those two divisions means it's a very powerful, trusted source of reliable information to help and guide investors to get a fabulous return on their investment. Something similar, Roger, to what we've been getting over the last 22 years, and we'll talk about that in a moment. But Fat Profits was founded by Angus Geddes, and Angus is seen as a bit of a visionary in the industry. He's one of the leading stock market research analysts, if not the leading in Australia. We're very proud of Angus. We're very proud of what we do here. And I can certainly recommend to our listeners Fat Profits is a trusted source of reliable information.
Very good. Thank you, Colin. And yeah, we have offices in Sydney, London, and Auckland, and we provide coverage for global markets, of course, as well as Australia, New Zealand, UK, Asia, US, you name it. So we've got coverage and recommendations for that market. Here's a picture of David Lennox, our mining analyst. You might have seen him on Sky News or Bloomberg or Ausbiz, and he's a geologist as well. He's been in business for over 10 years, but certainly been in the markets for many decades, and he's provided a number of multi-baggers in mining space. And look, we're one of the very few companies in the market where we have a big mining presence and research available for our members. And finally, this is the wealth management division, which I think Colin just touched on. And here's a picture. Colin, maybe over to you just quickly.
Yeah, I think the key takeout from this chart, Roger, is the performance against the index. You see the index is well below the Fat Profits return there, and that's an accumulated return of 338%. versus the income, versus the index at 122. So you can see it's roughly 3 times, a bit under 3 times what the index has been doing. So if you've got a partner, an investment partner like Fat Profits, helping you, guiding you, giving you guidance and direction in the market, and if we're performing at almost 3 times the index, then that's a pretty good endorsement of our expertise, our knowledge and our experience. And we like to help our members make lots of money in the market based on our high quality research.
Very good. And I just want to add that we're not stockbrokers, so we don't manage your money for you. You manage, buy and sell yourself. We will provide the research and you just continue to trade yourself. Now that's 2 points done. So first one is stay defensive. Second, raise cash. Third plan is avoid speculative growth stocks. So Gary, a lot of people are trying to time the market at the moment, which is very hard because it's up one day and down the next. So trading is very difficult in this market. You get stopped out pretty quickly. Why speculative stocks get punished in this sort of market?
Speculative stocks are often the fodder of day traders or short-term investors into the market, and they're very much driven by social media, what they think is going to happen in the future, and ultimately find out that it doesn't really occur. This type of market is really difficult. Speculative stocks don't rise with the tide, as they say in this type of market. They're really bound by day-to-day speculation and company announcements, which can be taken as good or bad. And it's really, you don't know until the announcement is out and the sudden price movement has taken hold. So it's a little different when we talk about the movement in the market. We're seeing some very, very good companies that are highly undervalued at the moment, really, that have shown consistent profits over many, many years, and their sentiment is poor in the market at the moment, so they're working their way down, but that will also change very quickly.
Well, here's a quick example of speculative companies like Zip, the buy now pay later company. We've been avoiding this for months and months and months, and we've been suggesting that in these webinars. If you watched this webinar in the past, you probably heard us talk about Zip and a few others. And look, they've just been going down and down. And if you're holding that, look, we apologize. We don't want to rub any salt in your wound, but certainly these are the type of speculative investments which will get slammed by the market. So we certainly encourage you to avoid them. I'm going to pop up a question now, just to engage our audience. So let us know, what's your current status? I mean, we want to get a bit of a feel of what's happening in the market. Are you fully invested at the moment? Are you partially invested? You have some cash available, or are you in all cash? Because there are a couple of investors, not a lot, a couple of investors we've come across who sold out completely a few months ago. So good on you if that's your plan. But we'd like to get a bit of a feel. So thank you. We're starting to get some feedback now. So I'm going to close that and get, there we are. And this just shows, it's going to make it big again. Yep. All right. So we've got the feedback. It appears that 62% are fully invested and about 30% are partially invested, partially cash. Okay, and there's a couple with all cash as well. There's always a couple, but most of you fully invested. So I guess our message to you is to consider making some changes to your portfolio. We're going to give you some suggestions in a moment as well. Now let's move on to commodities just quickly, because that's one area where we are encouraging investors to park some money. You've got to be selective though. You can't just blanket buy all commodities, but here's a quick look at what's driving commodity prices in particular is the mighty dollar. The mighty dollar has, US dollar that is, has gone up tremendously this year, had an impact on some commodities in particular, and you can clearly see the US dollar's had an absolute phenomenal run. It doesn't look likely that it's coming to an end just yet. It's probably got some last few legs on it, but it has an impact on certain commodities like gold, silver, copper, etc. Lithium on one hand, you can see at the bottom right, has had a phenomenal run, unlike the US dollar. It hasn't had an impact on lithium. But the first commodity we'll quickly touch on where we see an opportunity for you is gold. Gary, over to you. Why gold? What do you like about gold?
Yeah, so gold, this issue with the US dollar, we have a very strong view that the US dollar will return lower over the either late this year, early next year at some point. And this is going to really take the pressure off gold at that point and a lot of the other commodities. So there's a couple of key levels here in gold to be watched. Currently, we're trading around the 1676 level. It's long-time support level for the gold price, and a break of that even between now and early next year, we may see the next support level of 1446 tested. So we have a very strong view on gold, particularly Australian dollar gold, particularly Australian producers of gold, because the Australian dollar gold price has held up much better than the US dollar gold price, which is what we're looking at. Because the Australian dollar has declined, we're seeing that the margins for Australian producers have remained quite robust.
So this is one opportunity you can consider for the next couple of years if you've got a bit of a long-term time frame in mind. But we've got a number of stocks in gold that we can recommend. The other one is to look at is lithium. And I won't spend too long here because lithium is certainly, most people know, is used for car batteries in particular, but also for many other, industry standards. It has had a very strong run. And even though the US dollar has gone up, but this hasn't really stopped lithium from going up. One of the stocks we have benefited from is having Independence Group, IGO, in our portfolio. You can see on the charts here, it's had a pretty strong run, a few ups and downs, but generally long-term trend has been up. We did buy this a couple of years ago at $3.44, and we've held and held and held. We bought it multiple times along the way, and dollar cost average. And look, a $10,000 investment is currently sitting at about 42,000. We're still holding it. We're not buying it anymore. This is now a hold. But we do suggest to our members, if you have look at lithium or nickel, check out a couple of good stocks, but maybe not a good time to buy right now. We can add this stock to your watch list and maybe down the road when it becomes a buy. One stock maybe quickly, Colin, you can touch on is Qantas, the flying kangaroo. Had a pretty good run off late, and it's another one.
Yeah, thank you, Roger. The flying kangaroo is taking off. It's on a steep trajectory. It's really in a recovery phase post-pandemic. We did describe this as a reopening stock about 12 months ago, and it's kind of still in that trajectory. The tourism sector is firing up. The travel sector is firing up. People are returning to work, returning to their normal lives after the pandemic. Things are getting back to normal. Australians love to travel. We're a tremendous destination for travel. Qantas will do well going forward. It's had a pretty good run in recent months. So we're quite bullish on this stock, Roger. We think that this is really one to watch.
Yeah, absolutely. So these are the type of stocks where you can, if you're holding them or you're considering them, where the value is there, the earnings are on the way up, and they're holding up much better versus some highly speculative stocks. There is some value there for you to consider. Another space for you to consider is gas and oil, or energy in particular. We all know what's going on in the energy space, and that's certainly been pretty resilient, pretty sticky in terms of price. And one stock, which was the best stock on the ASX 100 last year, is Whitehaven Coal. Now, coal prices have gone up nearly 3-4 times in the last year, and they remain pretty high. Whitehaven Coal has benefited from that. So, Gary, what are your thoughts on this company?
Yeah, Whitehaven Coal's had an extraordinary run into the current prices up around between $10, $11 at the moment. It's a place of consolidation now for price. We're watching to see if this can push higher. The issue with Whitehaven Coal now is they have basically $2 billion cash in the bank. They're doing a buyback on the stock, which will hold the price up for a little while. We're interested to see how that pans out after the buyback is complete, or at the closing stages of the buyback, to see if the investors are willing to stay. So at the moment, good consolidation area in Whitehaven Coal. You can see on the chart here, just up around the above the $10 mark. It is an interesting company. Their cash flow looks to be pretty solid out to full year 23, even into full year 24. But we'd like to see first quarter results come through after this full year.
Very good. All right, so these are the type of companies you want to hold. So the next point, the fourth point of the plan is staying patient. Now, there's a bit of a funny picture on the right-hand side. You might recognize this face, Mr. Trump. But nonetheless, jokes aside, staying patient. Now, Colin, this is not something which comes naturally to a lot of people when they're seeing volatility in the market, and patience can be tested. So what can people do, and what's the benefit of patience in this volatile market going forward?
Well, thank you, Roger. There's an old adage called time in the market rather than timing the market. And that's very much in the mold of Warren Buffett, Berkshire Hathaway, to buy and hold, look at the long-term view, look at the long-term investment horizon. So by buying and holding, being patient, staying in the market for the longer term, you can ride out the variability. The way that we ride out variability is through dollar cost averaging. Dollar cost averaging is a fantastic principle to smooth out the variability in buy prices. But the most successful investors, Roger, they buy and hold, and Warren Buffett is testament to that adage.
Yep, sure is. And look, currently we moved a lot of our stocks from previous buy ratings to a hold. As you can see, some of them listed here. And this is just a snapshot from our website. So a lot of the stocks are moved to a hold, and we let our members know that, look, this is not a time to buy stocks, but certainly if you're holding them, you can stay. So here's a recap of the plan. These are the 4 points we've discussed so far. And if you agree with them, please let us know in your comments below, and we will appreciate any feedback. Now, before we get into a model portfolio, we are going to show you a portfolio now. In fact, 2 or 3 portfolios of people holding certain stocks and the amounts. And we're going to give you some ideas on how you can balance your portfolio in this market. Before we do that, here's a quick snapshot of our sell recommendations, because at Fat Profits, we also tell you when to sell stocks, when to move them to a hold, and then, of course, when to buy them. So here, I think Colin just touched on that earlier. Recently we've sold a number of stocks as half. Sorry, going back to the previous presentation. You can see there, the returns at the right-hand side based on a $10,000 investment. A lot of them have done very well. Obviously, the big standout is right at the bottom. You've got Hub24, a $10,000 investment there was turned into $175,000, obviously over a few years, but quite a few in the green. Look, we're not perfect. We don't get all of them right. There's a couple in the red where we lost money, but generally speaking, look, we do get 7 out of 10 right. And that's a stat that we're quite comfortable with. But these are some examples of freeing up some cash. Now, Colin, over to you to tell us a bit more about our performance, because a lot of people look at us and they go, well, okay, what are your results like? So maybe we could share with them how we've been performing over the years.
Yeah, certainly, Roger. And I've been in the financial markets for over 3 decades, and so I've been looking at these returns myself as an investor and a participant in the market. If you look at our performance since inception, and that's the 1st of October 2000, we've been returning via our Australasian Equities Report a figure of 17.8%. Now that's a combination of growth and income. Overall, that's providing a fantastic return to our members and investors. It's more than double the All Ordinaries Accumulative Index. And on that basis, Roger, our members are very happy. Also underneath there, Roger, you can see the 12-month figures from the year 2020 right down to 2015. You can see we're consistently outperforming the index, and some years that we're more than double and close to triple the index. So that's a fantastic testament to our performance in the market.
Yeah, look, I don't think anyone would disagree, and these are real results, audited, and they're on our website as well. So we publish them really proudly. Here's a quick look at how compounding returns can really skyrocket your investing goals. And if you'd invested $10,000 20 years ago and managed to get that 17 to 18% return consistently, that's the key word, consistently, over a 20-year period, and you added $5,000 each year to that investment. It's a very small little exercise, but just to show you, that would turn into $1.6 million today. That's nothing to sneeze at, and that's a very small investment each year, but it's just showing you the power of compounding interest if you can get that consistency. Now, Colin, we also have a lot of reviews independent from some of our members who shared their experience of our service.
Absolutely. This is an independent endorsement of the quality of our expertise in the market. And I mentioned a few times today that we guide our members. We publish regularly, we publish recommendations which they follow. Following those recommendations produce good results, and you can see some feedback there. There's one here from it's called Out of Pocket from Perth, WA. Would be lost without them. He runs his own self-managed super fund. He uses our research. He talks about being entrusted to super profits. And I mentioned before that we are a reliable source of trusted information. Our members really appreciate what we do for them because we produce consistently high returns. There's some comments there about David Lennox. Well, he is a resources guru. There's no doubt about that. He's recognised within the Australian share market as probably the leading resources analyst. We do very well off the back of David's recommendations. So do our members. And that's really a good reflection, Roger, of the quality of our experience, our expertise, our knowledge that we pass on to our members. We pass on to our members the knowledge that we've accumulated for well over 22 years. And so individual members can use that knowledge themselves in managing their own portfolio. And what you're seeing there from these reviews, Penny K, every investor should look at what Fat Profits offer, because what we offer is a pretty good information to make a good return in the share market.
Absolutely. Well said, Colin. Look, the research is important. You know, obviously you invest in your hard-earned money. So we do research all day, every day, and we provide all that information to you as an investor. So look, before we look at the model portfolios, and we're going to give you some good ideas to walk away with today, we are going to give you a few reasons to consider joining our service. If you're enjoying the presentation so far, if you appreciate the time and effort we put in to provide you some quality information to make some decisions in these volatile markets, here's a few reasons for you to join our service. So over to you, Colin.
Yep, thank you, Roger. Once again, performance at 18% per annum over 22 years. Now that's since inception. So that's the average return annualized over 22 years since inception. And we all know in the investment community, if you're making 18% on your portfolio, then you're doing quite well. But not only that, Roger, you save time on research. Now, research is very time consuming. You've heard Gary go through the chart today in this webinar. It's quite detailed. It requires a great deal of application and long hours. We can do that for you, and we simply share that with you via our emails, our webinars, and via account manager service calls. We do have experienced and reputable management. We've got a proven track record in the market that's unsurpassed by any other research house. We do get it right 7 out of 10. I think Roger's a little bit modest. I think some years we're much better than that, but over the 22 years, consistently we're getting it 7 out of 10 right. We provide guidance, we give an outlook, a macro view, and market direction. And these are principles and concepts that our members and investors really value very highly. Look, the other point too, Roger, while you're on it, there's no marketing or upselling. Some of our competitors are a little bit aggressive when it comes to marketing and upselling. You won't get that from us. We'll certainly stay close to you. We'll give you as much support as you want. And if you don't want support or contact, we'll leave you alone. We manage real money. And look, I mentioned this before, Roger, this is an incredibly important part of our service because we manage real money up to $1 billion, and it is growing every year, obviously. More and more capital inflows mean that our investments are a really key part of our research. So as we see these investments in the market grow through our listed investment companies, and through our separately managed accounts. It's from that experience additionally that we draw on that knowledge to provide that specific research and guidance to our members based on managing real money.
Where do I sign, Colin? You've sold me.
Well, maybe what we can do, Roger, after the webinar, we can do a screen share, and I can run you through some of the products on the website, and you could pick the membership that suits you the best.
Yeah, absolutely. Look, I must admit, just it's a very compelling case, because really, as an investor, what you're looking for is some guidance, some runs on the board, and save you time. And if you can make money like we have, why wouldn't you do it? So I guess if you're open-minded, and price is probably the only consideration. Other than that, we do tick all the other boxes. Because let's just be honest, if our information was free, everyone would join us, because there's no disadvantage. But really, the key comes down to, okay, what price do you need to pay versus what value you get? It's really all about what you get out of it. And look, if you picked up a Whitehaven Coal or an IGO or one of those stocks where you put in 10K and you're sitting on 40, 50K, you wouldn't have any trouble paying whatever money we ask for that matter. So I don't think price is a problem for most people. However, we do have an offer for you today where we can provide you a very good price package. But before that, we're going to quickly explain to you our 3 packages that we have available. So we have a standard package, premium, and a platinum, and you can subscribe to any level depending on your investing. And either one is tax deductible. We also provide an invoice. It can be invoiced to your self-managed super fund or your own personal name, whatever you like. That's not a problem. And look, the difference between the 3 is only a couple of small differences. So just to run you through the key benefits, you get the daily Fat Chat market commentary, which is an email from Angus every morning, Monday to Friday, and it hits your inbox in the morning around the market open. It gives you a very good summary of what's going on in the market every day and where Angus is seeing opportunity or threats, and he will provide charts and information every day. So you as an investor save your time and you read all the news as to what's going on. That's the first thing you will get every morning. Second thing is a weekly members webinar. Now, if you like this webinar so far, you are going to love our members webinars, because it's full of information directly to you as an investor. Now, when do we do them? Every Thursday at 12 p.m. for 1 hour. So that is live in our Sydney studio, and you can tune in from anywhere in the world and watch the live presentation. Now, it is Q&A as well, so you can ask questions during the webinar, and it is very informative. Now, if you can't make it live on Thursday, not a problem. We record it, and you can replay that at any time later. So that's available for you down the road. Third benefit is the Friday Fat Wrap. Now, that's not a kebab wrap, just to be clear. That is a fat wrap of any highlights that you may have missed out during the week. So Angus will send it on a Friday, and you will get the key highlights of the week. So those 3 benefits are available for all membership types, standard, premium, or platinum. The key difference is the report. So Colin, maybe you can run us through the weekly reports that we publish, and what's the difference?
Yeah, so we publish 3 weekly reports. Australasian Equities, that comes out on the Tuesday night. Global Mining, that comes out later in the week, and then Global Equities follows that. So for a platinum member, I'll just start with a platinum membership just quickly, and I'll go back to premium. So as a platinum member, you're getting up to 20 recommendations per week to buy, hold, and sometimes sell shares. So it's a very good basis, Roger, to run your portfolio of these weekly recommendations on those 3 reports. So the 3 reports are, once again, Australasian Equities. It covers the entire Australian and Asian markets. Global Mining is a fantastic report. We've got very high returns out of Global Mining, more than double the index, Roger, on the 5-year rolling average. Global Equities is a very high returning report. And just finally, before I pass it back to you, you'll see down the bottom there it says Premium Account Manager. And so that's where I come in as an account manager, provide help and guidance so that you as a member get maximum financial benefit from your membership, and you get maximum financial benefit by reading the daily Fat Chat, dialing into the weekly webinar, reading the Friday Fat Wrap, and following the recommendations. It's quite straightforward, it's quite simple, and it's very cost effective.
Very good, Colin. So that's the Platinum service where you'll get access to all of the above, and you also get an account manager who you can talk to. With the Premium membership, you can choose any 2 out of the 3 reports. So if you're not interested in global equities, which is the international market, you can just subscribe to Premium. You'll have the mining, which covers a lot of Aussie miners, and of course Australian equities, that covers the main market. So Premium is certainly very popular with our Australian investors. If you're an Australian and international investor, then you can go with Platinum. And the Standard, you can choose 1 out of the 3 reports. So if you're just looking at 1 report, you can go with Standard. Now, we have some special offers for you today because we have just completed 22 years in October, and that is a big milestone which we're very proud of. And as part of that, we are happy and to invite you to join our service today. And part of that, here is the deals. So first thing first, we have deals on Standard, Premium, and Platinum. I'll just quickly run through a couple and then I'll pass it on to Colin. So Standard price normally is for a year is just over $1,000. Premium is $1,545 for a year, and Platinum is $2,590 for a year. Now we've got deals across 2 years and 3 years time frame, because we do want to hold your hand in these volatile markets, and we do think that over the next 1 to 3 years, we are going to see a lot of change in not only your portfolio, but of course, global market trends. So we would encourage you to lock in a 2 years or a 3 year deal, and these are the prices. So over to you, Colin, to run us through some of the packages with the best value.
Absolutely, agree with you 100% about having a guiding hand to guide you through as an investor these choppy market conditions. And as Roger's just mentioned, the most popular bundle is the 2 year Premium. It's normally $1,545 per year, but if you come on board with us for 2 years to help you guide you through these market conditions, it's only $899 per year. But if you even want a better deal, the best value is over 3 years at $765 per year. It's pretty much 50% off, pretty close to 50% off. In fact, it is over 50% off the normal cost of Premium at $1,545. And just quickly while we're on it, Roger, Platinum, once again, some tremendous offers there. It's normally $2,590 a year, but we're actually running these offers this month, in the month of October. We can offer you $1,295 a year instead of $2,950 at $2,590. That's 50% off. And finally, the 3 year top tier Platinum, it's just $999 a year. That's a significant saving, Roger, over the normal price of $2,590.
Yeah, look, that's the one which when we did this last time, the 3 year Platinum got the most hits, mainly because we're offering an annual portfolio review included. Now that by itself usually is $1,000 price tag, but we're giving that away as free, included in the Platinum 3 year deal. So that is got all the bells and whistles. And let me pull up my drawer. I might have some steak knives left. So maybe we'll throw them in as well. In the Platinum deal. So look, these are the popular bundles. So what we would do is just give you an opportunity now to register your interest, and you can let us know which one out of those options appeals to you the most. So if you're interested in the annual review, I'm going to share with you a model portfolio in a moment, give you some examples of the reviews, the way we construct them, how we look at your portfolio and give you some direction and balance that out. So while we're getting you to click on the options, I'll take some questions which have come through. So the first question, in fact, has come through from Megan. And Megan's basically saying, oh, hi guys, thank you for the presentation. It's very informative and I appreciate your efforts in the presentation today. Thank you, Megan. The question she has is, she has joined Motley Fool recently, and she's bombarded with a lot of other upselling opportunities with different products. She's not very happy. So the question she's asking is, it's a very long question, so thanks, Mick. So I'll just run through it. So the question is, with no upselling, do you have any other products that you'll constantly bombard me with about buying another different product? So, Colin, do you want to answer that, please?
Yes, it'd be my pleasure to. And this is a real major point of difference between ourselves and a lot of our competitors, not just the one you mentioned, but we do have the 3 products, Standard, Premium, and Platinum. Roger mentioned the annual portfolio review service. They're our products. We guide you on those products at a pace that you're happy with, and we'll provide support on all 3 products. Now, where we believe it's appropriate, Roger, we may recommend you upgrade from Standard to Premium, or perhaps from Premium to Platinum. So if a member's doing very well on Australasian equities and global mining, but they'd like some exposure on global equities, then we will recommend an upgrade to Platinum. But we do not bombard our members with non-stop marketing, and our members give us good feedback on that very point, Roger.
Yep, very good. So yes, exactly. You get what you pay for. So that's it. And then the next one, just a comment from Jonathan. He's saying, I'm an ex-member of yours, and I've tuned in today to find some information. It's been top class, and I thank you and the team for your presentation today. Thank you, Jonathan. We appreciate it. And hopefully you can rejoin our service today with these specials. So I'm going to close that now because we're getting a fair amount of responses, and I think that's all done and dusted. We've got a lot of hits on Platinum. Actually, seems like the 3 years deal is popular, and also quite a few on Premium. So thank you for that. We're now going to show you, just to finish off the presentation, it's going to show you the portfolios that we talked about earlier. So these are a few examples of when we look at portfolios, what are we looking at? So this is an example of a member who sent us these screenshots. So they're holding a number of quality companies. However, the balance of some of these holdings is probably a bit out of whack. So you can see the Allchem right at the top there. That's the lithium producer. Its value has now gone up to $350,000, which is obviously quite a big profit there. You've got some banks, BHP is actually part of that, and so on. But generally speaking, what we did was we did look at the balance of this portfolio. Some of them a bit on the heavy side. So we did trim or suggest a few sell halves just to lock in some cash. But this particular member was fully invested, so we decided to help him with raising some cash, and we balance that out. So that's one example. Another one is this one. So this is a smaller portfolio of about 20 stocks. Most of them are reasonable. However, again, AKE right at the top in green was a big standout. The border at $2.40, reached $14. So this one actually shot the lights out. Clearly, they were very happy. Didn't want to sell it. You don't want to blame them for that. But that was a bit out of whack in terms of balance. But you look at the 4 in red, these are the gold stocks that this person owns, and they've got about 12% in total of gold stocks in their portfolio. So we consider that as reasonable because we are quite bullish on gold and otherwise. So this is just a bit more balanced, but 1 or 2 stocks here and there. This portfolio, on the other hand, is actually on across 2 pages. A lot of stocks owned by this investor, and we looked at the weighting, which you can see on the right-hand side. And in particular, if you scroll down to the bottom, you will notice the one. Sorry, I'm just struggling to see that now. Not this page, it's the next page. Woolworths right at the bottom, and they own about 8%. So that's their biggest holding. So that's something to consider, just trimming some of those stocks down. But there's also a lot of other stocks that they are also speculating on as well. So when we look at these portfolios, we look at the balance, we look at the allocation, we look at the cash levels that you're sitting on and what would be an ideal number. And we look at how many defensive stocks you have and versus the speculators. So we provide a pretty thorough, detailed portfolio review service where we can go through all these stocks together and provide you the general advice on how to construct it slightly better. So hopefully that gives you some ideas on what we can do. And look, I'll sum it up now. Look, thank you for your time today. If you have any further questions, please email info@fatprofits.com.au and we'll be happy to come back to you. If you enjoyed the session today and you want to join our service, then yes, certainly we'll get in touch with you and provide you the information that you need. I'll pass it on to Colin first to say his final words. So over to you, Colin.
Yes, well, thank you, Roger. I think what we covered today should be a valuable insight into the product that we have for potential members. I want to thank Gary as well and thank everybody for joining in today and look forward to being in contact with you and all the very best in the markets.
Thank you, Colin. And Gary, over to you.
Yeah, thank you, Roger. Thank you, everyone. Colin, one thing I'd point out, Roger, you mentioned the members webinar on Thursdays. The analysts, we sit in on that webinar and clients are actually welcome to come and ask us questions directly about recommendations we've made or other parts of the market. So that's available to them. But be aware that there is some tremendous opportunities coming up in the market here, long-term opportunities coming up in the market here, and we'd be pleased to give you that information. So thank you very much again. Thank you, Roger, and we'll talk soon.
Okay, bye for now.